In this video, I'm going to show you exactly what you need to know when reviewing a loan estimate, which, by the way, the loan estimate, that's going to be the most important document in the beginning process of your home loan journey. It's going to play an important role in shopping for a mortgage. And once you decide on the lender that you're going to work with, it's going to be important that you know how to read this document so that you know that you're still getting the best deal. I'm a mortgage broker with over 20 years of experience, and on this channel, I share the tips and tricks that I've learned over the decades to help you in your process of purchasing a home. All right, so let's talk about the loan estimate, which is basically an itemization and a summary of the loan that the lender's quoting you. So when you shop around for a mortgage, when you get quotes, what you should be receiving is what's called a loan estimate, which, by the way, is a standardized document. In fact, the government designed this document. It's great. And so this document that came out in 2017, the government requires all lenders use the same document to provide quotes to consumers so that it's easier for you to shop around, because back in the day, everybody had their own quoting system. And so if you were looking from lender to lender, it's really hard to do a side-by-side comparison. Now, the loan estimate is a 3-page document. Page 1 is a summary of the transaction. It's going to give you a summary of your total closing costs, your total cash to close. It'll say who the lender is, what kind of program you're getting. The second page is going to be an itemization of every single dollar that you're going to pay in order to get the transaction done. And page 3, basically like they combined a whole bunch of old disclosures to cram them into one disclosure when they did this update. And although page 3 does have important information on it, it's not very important. So focus on pages 1 and 2 because that's the meat and potatoes of what you're really looking for, which is what's the monthly payment, i.e. the interest rate, and what are the total costs. Everything else is just information that, doesn't make a big difference at the end of the day. Yeah, you have a right to receive a copy of your appraisal and know if the lender is going to service your loan or sell it. But let's be real here. You're shopping for a mortgage, and so you want to figure out where the best deal is. And so using your LE, your loan estimate, to do that comparison, it's going to be your best route. All right, so let's start with page 1 of the loan estimate, and let's break this down section by section. So on the top of the loan estimate, it's going to say like who the lender is, the loan officer, the address of the property, the loan amount or the sales price. And on the right-hand side, on the top right of this document, there is some important information where it talks about specifically the loan program that you're being quoted, but more importantly, is the rate locked? You see those boxes where it says yes or no, is the rate locked? If it says no, then this can change. That quote that you're receiving, it's basically as good as the time that it was printed, but the market is constantly changing, guys. Interest rates are not static. They change all day long, every single day, Monday through Friday, they update. And so if your rate is not locked, your quote is subject to change. So keep that in mind. If it is locked, it's gonna have a date that states how long your rate is locked for. At that point in time, you're going to have to either extend your rate lock or you blow through your rate lock and you have to get the current pricing, which usually isn't the best route. Usually you're going to want to extend that rate. All right, so the next section talks about your loan terms. So you see like the black bold box says loan terms. This next section is basically giving you a summary of the loan that you're applying for. It gives you the loan amount, the interest rate, which is really the most important thing for the most part, besides how much closing costs you have. And then it shows what the monthly principal and interest payment. And you notice on the right, it says no. That's where it says, can these things change? So if you're getting a 30-year fix, then that should be a no. And since you're not doing like some crazy NAGAM loan or something like that, then your loan amount, that's not going to change. So all of those boxes should say no. Now under prepayment penalty and balloon loan, those should also say no, because in fact, if you're getting a qualified mortgage like a Fannie Mae, Freddie Mac, FHA, VA, USDA, all of those loans require that there are no prepayment penalties or balloon features. Those are illegal features. So that should always say no. If it says yes, that's probably something that is a red flag. All right, so let's go on to the next section. So this is your projected monthly payments. And this is where you actually get a breakdown of your principal and interest plus your taxes, insurance, and it will show your HOA dues. But bear in mind, HOA dues are not included in your escrows or impounds, depending on what state you're in. And that, by the way, is where your taxes and your insurance are included in the monthly payment. Now, this section always confuses people because you'll see, like in this breakdown, it shows from years 1 through 13, there's this payment, but then for years 13 and beyond, there's this other payment. Well, wait, I thought I was doing a 30-year fix, or that the loan shouldn't change. Well, it doesn't change, but you'll notice in this loan scenario, this made-up scenario, this is a 5% down loan scenario. So you also noticed in that payment breakdown that $75 a month is mortgage insurance. And so if you use the amortization scale, basically at like 13 years, the mortgage insurance would naturally fall off, assuming they don't refi or challenge the value sooner. And so that's why you've got the breakdown of 1 through 13, 14 through 30. And you will always see a breakdown like this when you've got mortgage insurance, or if you're doing a 2-1 temporary buy down, or if you're doing an adjustable rate mortgage, you will see more information on here. So it's important to do the side-by-side comparison to look at what's actually changing. And on this, you'll see the only thing that changes is the removal of the $75 private mortgage insurance. All right, so the last section on page 1 of your loan estimate is the costs at closing. Basically, like, what money do you need to come up with to close your transaction? And this is going to be a combination of your down payment plus your closing costs. And if, for instance, you've already made a deposit, like you've got an earnest money deposit in, well, this should be reflected in those funds to close. So in this example, there was $10,627 in closing costs plus a 5% down payment. So the cash needed to close, the total cost needed to close this transaction, came out to $35,627, hence those numbers you see there. So page 1 is designed for you to be able to do a quick look, to know what your interest rate is, to know what your monthly payment is, and to know what your total cash to close the transaction is. This is a summary, whereas the next page is a deep dive into what those costs are. All right, so page 2 is going to be very important in your shopping process, because when you're shopping for which lender to work with, there's certain areas in this page that the lender has direct control over, but there's other areas that the lender has nothing to do with. It doesn't matter what's in that box when you're shopping around, because ultimately they have no control over what that number is. Like, for instance, property taxes or title insurance. They don't have control over that. On page 2, the thing that the lender has control over is box A, which are the origination fees, aka lender fees. And then under section J, where it says lender credits, if you are getting a lender credit, that's where it would show up. So when you're price shopping from lender to lender, there's basically a couple of things that you're gonna look at. You're gonna look at the interest rate, then you're gonna look at the total cost of box A, which is the first section of page 2. Now in this example in box A, the only fee is the underwriting fee of $1,055. But this is an area where you will see lenders pile on junk fees, admin fees, doc fees, wire fees, fees. You also see this is where paying points, discount points, basically prepaying interest up front to get a lower rate than what would be offered to you without those fees. That is where all of the lender fees are going to show up, is in this first box. And like I said, when you're shopping around, this is one of the most important pieces to the puzzle to determine who's got the best deal. So the next section, box B, although the lender does have some slight influence over this because they basically pick the service providers, let's be real here, the cost from service provider A to B to C doesn't really vary by that much. So at the end of the day, you're going to pay around the same amount of money from lender to lender for a credit report or an appraisal or whatever, because they're not allowed to add fees onto it. That's an illegal activity. So whatever you see in box B, there's actually going to be invoices provided for those fees, but these are services that the lender had to use to get your loan done. So they're passing those fees on to you. Now, box C, this is one where on estimates, on quotes, you always see a lot of these fly-by-night companies where they go super skinny on these fees. These are the third-party fees, title, escrow, notary, all sorts of BS fees that you'll see. Well, at the end of the day, the lender has nothing to do with these fees. They are not the ones charging these fees. And so what they do a lot of times is in the shopping process, they'll provide a quote with some really low third-party fees because ultimately it makes the total quote look better. But at the end of the day, since they're not the one that's picking title or escrow, the seller, the builder, basically the person, not the lender, is picking that, and ultimately you're going to be stuck with whatever the fees are for that company, not the BS ones that the lender puts on there. Now, once you're in escrow and you've already decided on the lender you're working with, this is important to look at because that's when we're going to really know exactly what those third-party fees are. Because in your typical purchase transaction, the seller picks who title and escrow are. Really, it's their listing agent. So since those fees vary from company to company, those are estimated up until the point of your initial disclosure package when you're actually in escrow to buy the house, which that's when you'll get another one of these loan estimates. So the difference though is on that loan estimate, instead of the property address being TBD because you're still shopping, instead now it's going to have the actual address of that property because this loan estimate is for that transaction. Now box D is just a summary of A, B, and C added together. Now, when you go to box E, these are your government fees. This is going to be recording fees, county, city transfer tax fees, stuff like that, okay? Again, something that the lender has no control over. The government's going to get their money one way or another. So what a lot of people do, a lot of shady lenders, when they're providing quotes trying to make it look sharper than what it really is, they are going to go really light on those government fees. And then once you're actually in escrow, you'll see what the real story is. Now, box F, these are your prepaids. And this is another area where lenders, if they're not being honest, they can kind of fudge the numbers a little bit to make their APR look lower than what it is. That's your annual percentage rate. Now, the way that they do this is when you're getting a mortgage, you are going to pay prepaid interest from the day your transaction closes to the last day of the month. So example, let's say there's 30 days in the month, we close on the 15th. Well, you will have 15 days left in the month, so you pay 15 days of odd days interest. But let's say on your quote, we don't know when you're going to close. We don't know. You're not in escrow yet. What do some lenders do? Well, they put like 1 day, which is not realistic, really. And what that does, though, is that's less interest charge, which makes for a lower APR, which when you're comparative shopping, that's one thing that you might look at and be like, well, this company does have a lower APR, when really their fees are actually higher, but since they're fudging on the prepaid interest, it looks lower on the APR. Now, what we typically do on our estimates is put 30 days of odd days interest, which is like the most that it could be. And we let you know, hey, this is the most that it could be. And for every day that's shaved off of your transaction, comes off of there. That way you know the worst case scenario. Because at the end of the day, we want you to have all the information up front so that you can make an educated decision in buying your house. Now in your prepaids, this is also where, like, if you were buying a house and you have a homeowner's insurance policy that you're paying for, things like that, that's where those things will show up. Now the next section, section G, this one can get a little expensive. Now section G is if you have decided to include property taxes and homeowner's insurance in your monthly payment on your purchase. If you're doing an FHA loan, you don't have a choice. You got to include it. But if you're doing a conventional loan, you're doing a VA loan, you do have the choice to have it included in your payment or not have it included in your payment. If you do choose to have it included, which the term for that is, in California, they call it impounds, and everywhere else they call it escrows. Okay, so if you decide to have that in your monthly payment, the lender, they got to collect reserves to ensure that there's enough taxes and insurance in your account to cover the bills when they come due. So if you elected for impounds in this section, you will see, 5, 6, 7, 8 months of property taxes and usually around 3 months of homeowner's insurance. So you got to factor that in if you're going to include those in your monthly payment. Section H, they list this as other, but if you're buying a house, this is where you will always see the owner's title policy. And for whatever reason, when the government made this form, it says optional in parentheses. Guess what? It is not optional. So that comes up at question all the time, drives me nuts, but I don't make these forms, guys. So this is also where if you had a home warranty or like additional like homeowners association fees, stuff like that, they would show up in this section. Now box I, that's basically you take E through H, add those numbers up, and that's box I. Now box J, I mentioned this earlier when I was talking about lender credits. Now box J is where they take both summaries, because you got the left side fees and the right side fees basically, which if you didn't notice, the left side fees are the fees that you pay to the lender and the title and escrow company. The right side fees are basically like taxes, insurance, stuff like that. But when you add all of those together, that's where J comes into play. And that's your total costs when everything's added up. And If you're getting some sort of lender credit, which isn't often, usually you see that on new construction where there's a builder incentive, but if you're getting some form of lender credit, that's where the credit would show up. Now on the bottom right where it says calculating cash to close, this is where if you had an earnest money deposit, so like if you go into escrow and you got to deposit 1% of your purchase price, the purchase price was $500,000. Well, that's $5,000 earnest money deposit. You would see that in this section. And ultimately at the bottom, that estimated cash to close, that's the number, which by the way, was the bottom number on the first page of the loan estimate. That's the amount of money that you need to come up with to close your transaction. All right, so we covered page 1 of the loan estimate, which is a summary of your transaction, your rate, your payment, the cash to close. We just finished covering page 2, which is an itemization of all the closing costs from every dollar that's going to come out of your pocket to get the transaction closed. Now, let's talk about page 3. And I know I've made fun of page 3 a little bit being not that important, because at the end of the day, all they really did was they just crammed a bunch of other disclosures onto this page, which kind of shows you how important those disclosures were to begin with. But let's look at page 3. All right, so at the top of page 3, really, it's going to have the contact information for the lender. If there's a broker doing your loan, on the right side, it'll have the broker's contact information. On the left side, it'll have the lender's contact information. If it's just the lender, it'll be that all the way across the top. Now, in the next section, this is where there's some information that can be a little bit confusing. But basically, the first box under comparisons, it shows you how much you will pay over the first 5 years. That's how much principal, interest, insurance, all that stuff. How much you'll pay over the first 5 years. Now the next piece is your annual percentage rate, APR. I mentioned that earlier. Now when the APR was created way back in the day, the idea for the APR was that you would be able to shop APR to APR to determine who has the best deal. Basically, the APR is like your interest rate plus your fees blended into your interest rate. And so that interest rate that you see in the form of an APR factors in your closing costs. And the idea is that basically whoever has the lowest APR has the best deal. Now the number on here that just drives a lot of people bananas because it looks way crazier than what it really is, but they call it the tip. And I'm not talking about just the tip just for a second. I'm talking about total interest percentage. And what that is they show you basically if you were to take the total amount of interest that you pay over the life of the loan in the form of a percentage of how much the original loan was, what is it? Well, of course, it's going to be more than what you started off with. So when you look at this, it always looks crazy because it's like this one says 139%. Well, that's not the interest rate that you're paying. That's the total amount of interest over the life of the loan in the form of a percentage based off of what you originally borrowed. So again, it's kind of confusing. Now, under the section where it says other considerations, I was talking about how they took a bunch of other disclosures that I'm sure were very important and they crammed them into this little tiny sentences on the bottom of page 3 because they were so important. Stuff like, you'll get a copy of the appraisal. Is the loan assumable or not? Which I got a great video about loan assumptions. Homeowners insurance, late payments, refinancing, servicing. All those little disclosures in there, which at the end of the day, although everything's important, the meat and potatoes is page 1 and 2. Now at the end of it, you're actually asked to sign and date this. Now, if you're working with Old Way Mortgage, they'll actually have you print this and actually sign your name and mail it in or scan it or whatever. But hopefully the lender that you're working with has current technology and all of this stuff should just be electronically signed. Now, you should receive this disclosure within 3 business days of your initial loan application. If the lender's not providing that to you, they're out of compliance. So there's really no reason why they can't get that to you. All right, so there you have it, a breakdown of the loan estimate, which by the way, the loan officer that you're working with, unless you're working with us, which we'd love to be that loan officer, the loan officer, they should be willing to do this breakdown with you. They should be willing to answer any questions that you have. I mean, at the end of the day, you're talking about buying a house, not a pair of shoes. So you should have a lot of questions. So make sure that whoever you're working with is willing to spend the time to break this information down with you so that you feel good about making an educated decision. I hope you got value out of this video. If you did, do me a huge favor, tap that like button, give me a subscribe, and I'll see you on the next video.